into a live conversation that my colleague Sajid is having with Indrajit Agarwal, who's a senior research analyst at CLA, on the sidelines of the conference that CLSA has in Mumbai. So let's cut in live there and listen into his comments. What did I say?
Thank you, Asisha. I have with me Mr. Indrajit Agarwal, who is the senior research analyst looking at cement, consumer electronics, and materials and other sectors. Indrajit, thank you very much for joining us today on ET Now. Let me begin with the cement thing. That's a story that has been building up. There's a consolidation happening in the sector. How do you sum up the second quarter? Because it's supposed to be traditionally a little weak because of the monsoons.
No, absolutely right. So second quarter of all the 4 quarters is always the weakest. You have the lowest utilization, not just because of the ability of the companies to ramp up, but also because of wetter weathers. You generally have a much lower volume growth in that quarter. But contrary to our expectation, demand in this quarter turned out to be slightly better than what we had initially expected. If you look at some of the growth of all companies, I would think that it has been somewhere close to mid-single digit or a tad higher than that versus our earlier expectation of, let's say, low single-digit kind of growth. And it is not driven by one particular sector or two particular sectors. When we look at the commentary of companies, housing, government, Capex, rural, everything has been sequentially better than what we have seen in the past few quarters. In addition to that, if I look at the pricing environment, that also has not been as bad as it is in the traditional seasonality. Generally, in this quarter, we see something around 2.5%, 3% kind of price decline sequentially. This time around, it was restricted to less than 1%, so that clearly helped.
Do you think the pricing will hold? Because we saw our last 2 quarters pricing, coming up, and you said in the seasonally weak quarter, it's held actually. It didn't fell much. So this pricing pressure which used to be there in last financial year, do you think it's going to hold this time around?
So if you look at what has happened, let's say in the last 8-10 quarters, one, demand was quite weak. After seeing a robust growth since 2022, since almost May of 2024, because of elections, weaker consumer sentiment, much harsher monsoon, demand has been weak. In addition, the consolidation was still ongoing. But in the last 24 months or so, about 10 to 12% of industry's capacity has changed hands in favor of the larger players.
The Adani Group and the Birla Group, basically.
So top 5 players, again, account for more than 80% of the capacity in almost all regions. Right? One region which was traditionally very fragmented, that is South, is also seeing meaningful consolidation. So that brings in pricing power. Companies have expansion plans, but organic expansion is not as bad in terms of pricing environment as is inorganic, because that takes time to ramp up, and hence you have that wiggle room to still keep the prices on track. So I think that is why we will see that prices will be a lot more disciplined than what we have seen in the last couple of years.
And what about Capex? We spoke about the government Capex or the central Capex and state Capex coming in, and in various segments where the demand will come in. But private Capex has been a little slow to be there. It is there, it is not, I'm not saying it's not there, but do you see that as a tailwind for the sector like cement?
Absolutely. So if you look at the RBI data that comes out on the private sector utilization, that has been inching up, nothing blockbuster yet. We have still not crossed that the thumb rule of 80%, where you really find the capacity to be stretched. But at the margin, it is rising. That should help. But I think that is a much smaller driver. Private Capex probably would account for 15-18% of cement demand. The 2 key drivers have to be government Capex, which has a follow-through impact on rural demand as well, and the housing demand. So I think these 2 segments are again seeing some bit of pickup overall with the government initiatives that we have seen in the past 12 months.
And consolidation will continue for some time here, because both the groups have given steep targets of consolidation and having capacities in the next 3 to 4 years actually.
So I think in terms of inorganic expansion, I think most of the assets are now behind. There are a couple of assets here and there which are still on the block. But the targets that you mentioned about, these are all organic expansion targets. Now that is like a 2-3 year horizon in which these groups can keep adding capacity. Again, if you look at the organic expansion as well, it is being done by the top 3-4 companies only. Right? So that helps in keeping the market more consolidated.
You began by saying that the growth has been mid single digits there. There was a time when we were growing at almost close to 8 to 10% in the sector, and at that time the organic growth meant that the demand was also there. Do you think that the kind of growth which has been articulated by many of the companies, is commensurate to the kind of demand that can come in the next couple of years?
In the next,
are we going to see overcapacity in this sector? That's what I want to ask.
Overcapacity will always be there in the sector, right? So what we have seen, current capacity utilization is somewhere close to 70%. And if I add up the announcements by most companies, that almost matches the incremental demand that is going to come through per our estimates, which is somewhere close to 6 to 8% demand growth, right? But what that also means is, given that these capacities are being added by the larger players, we will not see the kind of price destruction that we have seen in the last couple of years, right? Okay. So I think the pricing discipline will be driven more by consolidation rather than utilization going up meaningfully.
And the consolidation is also bringing in pricing power as well to hold on to the rates?
To hold on to the rates, correct, right? If you look at cement historically, if I go back, let's say 15, 18 years, cement prices have never grown anywhere in line with inflation. The last 20-year CAGR of cement price is somewhere around 3.1, 3.2%. Right now, we are penciling in somewhere close to 2%, right? Despite the kind of inflation that we can see in this industry, right, or in the country as a whole. So I think even with 1.5%, 2%, there is meaningful earnings upside for the companies.
Another sector that you track is the metal sector, and that's a lot of things has been written about it with respect to the kind of growth, the kind of pricing, and we've seen now a phase where some bit of cooling off of pricing has also happened there. How do you see the steel sector, and the aluminium sector?
So now these, for once, are very different to cement. Right? Cement is a lot more domestic sector. Whatever happens globally in, let's say, cement demand-supply balance does not impact the domestic market. Right? Steel and aluminum both are absolutely or largely global sectors. Aluminum more so than steel. First, coming to steel or the ferrous part of the industry, we are relatively more cautious on this segment than the non-ferrous or base metal side.
Because many of the companies have their own captive mines as well, right, in this sector?
That is one part. That is a risk that would come, let's say, post-2030. But more importantly, near-term demand-supply dynamic is not looking that interesting for the sector as a whole. In its glut of 2015, 2016, China used to export 100 million tons of steel. The global steel trade is somewhere between 600, 650 million tons, right? Today, China is going to export in this year at least 110 to 120 million tons of steel. So there is an overcapacity from China, which looks like will take some more time to die down. Right? Second, if I look at the flat steel market domestically, given the capacity expansion by the top 4 or 5 players, the ramp up of those, we will continue to see some bit of temporary demand-supply mismatch. Maybe that gets covered in the 3rd year, 4th year from now, but that would mean that the pricing power of the domestic mills will be fairly limited. Third point is the safeguard duty. While we have had that benefit till earlier this month, that has exhausted. For all practical purposes,
they're asking for an extension. No?
Exactly. So for all practical purposes, we are building in our numbers that safeguard duty will be extended, and hence prices will strengthen from here. But it is unlikely to be significantly different from the global price trajectory that we have seen.
Interesting. So many of them have put in a lot of capex in play there. So how do you play that this sector then?
So again, steel being more cyclical than cement, right? So that is why we tend to look at it more near term. But if you look at the companies that are adding capacities, these are all ROC accretive capacities that are getting added. If you do the math, it is more than 15-18% ROC at least in all expansion practical purposes. Second, as you correctly mentioned earlier, iron ore is an asset in India, right? We have a much lower cost of iron ore than globally, much better quality of iron ore than most of the other exporting nations, right? So what that means is, as the demand picks up, say 5 years, 7 years from now, it is sensible to keep adding capacities, but there would be these temporary phases of few years of demand-supply mismatch.
And you mentioned about the 2030 risk which is coming in. How do you think companies will play out on that?
So again, it will play out differently for different commodities, different categories. Comparing with cement and steel and let's say aluminum, right? Cement again is a lot more domestic. This is, and almost every company have their own captive mines, because that is, other than that, it makes very difficult to make reasonable ROCs in this industry, right? So there I would expect it to be a lot less competitive, versus in steel, where a couple of companies have captive mines in the older regime at lower cost, a couple of companies don't. So I would expect those mines to be very hard fought. So the cost benefit that they had could come at risk for the companies which had.
So the realizations will be under pressure for many of them?
The cost will be at the pressure. Realization anyway is more global.
Yeah, global in nature.
Yeah, so the cost, iron ore cost, the mining cost will be under pressure. That will rise, so that could keep your profitability in check.
You know, the third sector which you manage is EMS, which is which everyone looks forward, and there are multiple companies here with multiple sub-sectors they cater to. You know, Dixon caters to the telecom, mobile segment. You have Amber in aircom. You know, others which are doing it. Give us a sense of how EMS is doing as a whole, and within the EMS, which are the segments which you see as a risk, or which are a sunrise for them, many of them.
So I think if you look at the sector as a whole, and we had Mr. Sunil Vachani in the conference yesterday, we had Mr. Piyush Goyal talking about these sectors in the conference yesterday. Again, today we have one more session on this sector. This is not a sector, or these are not sets of companies where you look at earnings on a quarter-to-quarter basis, right? If you try doing it, you'll never get your head around valuation, you'll never be able to buy anything, right? So what you have to look at on a 5-10 year horizon. And I think as a sector, just by way of import substitution in almost all categories, the industry can grow at 15-18% dollar revenue CAGR for the next 15 years.
Okay.
In this, again, this is a very fragmented market. If you look at SMT lines, there are at least 600-700 companies which do outsourced PCB assembly, right? So I think there will be a lot more consolidation, there will be a lot more inorganic expansion from the companies. For me, the two key criteria that I'll look for is one, the overall TAM of that industry, right? Let's say if it is smartphones, if it is PCB assembly, if it is OSAT, and of that pie, how much can you pick up? Number one. Number two, what kind of free cash flows you are generating? And number three, which is the most important part, what is the management mode? I think